Hey, good afternoon, everyone. Thank you once again for joining us this Wednesday. My name is Hector Aguilar with the Aguilar Realty Group, and today our topic of conversation is the skyrocketing mortgage rates. That's the topic that's been kind of hot in the news every single day, with inflation being up and the interest rates being affected on the mortgage side on a very, very high level. So stay tuned. Would love to kind of inform you as to maybe some different mortgage products that are out there for buyers that are still in the market, and to kind of give you an update and an outlook as to what interest rates are going to be doing moving forward through the end of 2022. So interest rates, yes, they have actually gone up quite a bit. I know we talked about this a few weeks ago, but I wanted to kind of revisit this particular theme because I think there's a lot of buyers out there that are getting a little scared about the rates that are going up, but they don't know about other loan programs that could possibly give them lower interest rates for a set term period. So I wanted to talk about that today too. As of today, and please understand, I'm not a licensed mortgage loan officer. I've been in the business 30 years. I was a mortgage loan officer for 8 years, so I understand the mortgage industry a little bit better probably than most real estate agents. But please understand, I'm not a licensed mortgage. I'm not going to quote any interest rates or costs. For that, I would recommend that you discuss it with your local professional mortgage loan officer, either at your local bank, a mortgage broker, or even your credit union. These are places where you can go and talk to a loan officer. Do know that the interest rates are tied to the market in the 10-year Treasury bond. Right now, the Treasury bonds are at about 3%, so that affects the interest rate quite largely in terms of them going up. So at the beginning of the year, we had interest rates that were still hovering at about the 3%. As of right now, a conventional loan for the conventional loan limit on a 30-year fix with someone that has fair to decent credit is going to be somewhere around 4.75 to 4.875% fixed for 30 years. Yes, about 2% higher than it was at the beginning of the year. I get it. It's concerning. We're talking about, or we're hearing about, pardon me, on the news that the inflation rate has gone up above 7% and is continuing to go up. The cost of homes is still continuing to go up. And I'm going to talk a little bit about exactly, what we envision in terms of the market, in terms of pricing, and the reasons why I don't believe it's going to crash. But we'll talk about that as well. So I wanted to also tell you that the VA and FHA rates for someone that has decent to good credit and are going to be somewhere between 4.25 to 4.375. Yes, a little bit lower than the conventional, but keep in mind that that's going to have a mortgage insurance premium that you're going to have to pay, or what's called, for FHA, it's called mortgage insurance premium. For conventional, it's called private mortgage insurance. So similar names, but different for different programs. Okay, so for that, those are again 4.25 to 4.375. Now, don't be afraid, in terms of what the rates are doing now, but definitely keep an eye on what the market is going to, do moving forward through the end of the year. The Mortgage Bankers Academy, Freddie Mac, Fannie Mae, Ginnie Mae, these are four government entities that are predicting what rates are going to do at the end of the year. When we started this conversation a couple months ago, or even at the end of December, it was rumored that we're going to be in the 4 to 4.5. Well, we've blown past that already. We're at 4.75, approaching 5%. And the experts are saying that we could see interest rates hitting 6% or slightly above. So honestly, if you're a buyer, you have to understand that your buying power has actually decreased every time the rate goes up. What do I mean by that? Is that on average, every time the interest rate goes up 1% from where it was before, a buyer loses buying power on average of about $100,000. So for example, if you were approved for a mortgage for $1 million at the beginning of the year, and now the interest rate is at least 1% more, guess what? Your buying power now is going to be around the 900,000. So what does that do to your pool of choices? It actually reduces it, right? Because homes are selling for above that, or there's inventory that now is lesser in that price range. So you're going to be competing more. So my recommendation to you as a buyer is absolutely get some quotes, try and find out what your new payment's going to be. And if you want to stay in the same payment, you have to kind of lower your price point, right? But be aggressive. Don't be afraid. Make some good offers. Talk to your agents and see if they can make the best offer for you. Maybe reducing your contingency period. Maybe in most cases, you're going to need to waive your appraisal contingency. But the truth is that it's absolutely important for you to understand that the higher the interest rate goes, the less you're going to be able to buy in terms of price, unless you're willing to go above that initial budget you spoke about. Okay. One of the things that I wanted to talk to you about today was, considering other loan programs. What do I mean by that? There's programs that are called adjustable rate mortgages, right? And yes, I know there's a lot of negative feeling towards adjustable rate mortgages. I've been in the industry 30 years, like I told you before. I started back in the early 90s, 1992 to be exact. And back then, we were refinancing people out of 12, 13, 16% interest rates and putting them into properties, or pardon me, interest rates that were 9 or 10%. And typically what would happen, they would be excited about, lowering their rates, right? At that time, adjustable rate mortgages were really, really bad. But since then, programs have changed. Right now, there's some amazing adjustable rate products that most buyers are unaware of, right? There's what we call a 10-1 ARM. And basically, it's a 10-year fixed rate on your loan for a period of 10 years. And then it'll adjust at the end of the 10 years, and it adjusts once a year. Now, there are some caps into how much it adjusts. It could be 2% plus whatever margin at that time. And some of them are even capped to go up no more than 1% per year, or maybe 2% per year. Again, for those details, I would recommend that you sit down with your loan officer, with your loan professional, and find out what those caps are. You could initially or essentially lock in an interest rate maybe at half a point, maybe a quarter point less than a 30-year fixed, and you have the assurance that it's going to be fixed for 10 years, and that you're not going to have to worry about adjustable mortgage payments year in and year out. There's also a 7-year one arm rate loan that's called the 7-year fixed, 1 year adjustable mortgage rate. So again, similar concept, typically a little bit lower interest rate than a 10-year fixed for 7 years, and then it adjusts once a year with some caps. And of course, then we have the 5-1 ARM, which is a 5-year fixed and then adjusts once a year with margins and a couple of caps. Again, it could be a good opportunity for you to still buy a house, have an interest rate that's relatively low, typically about half a point to 3/4 of a point lower than your fixed rate loan. But you'll be able to get into a home, have a lower mortgage payment, still buy a house. And we know that the election year is coming up in a couple of years. And traditionally, if you look back in history, we've seen that interest rates have typically dipped during election years. Why? Because you have the new administration that's potentially coming in, and what happens is the market adjusts, and we've seen interest rates drop. So it could be a good opportunity for you to maybe refinance out of an adjustable rate mortgage at that time and get you into a fixed mortgage product that's probably equal or less to what you're paying for now. But at least you're able to secure an interest rate that's at least half a point to 3/4 of a point less than your fixed rate loan right now. Now, the rates I quoted you for conventional are what we call your conventional loan balances, right? Depending on the county, it could be 625 for single family residents. It could be 900 and change if it's in certain high price counties. But there's also a high balance type of loan, right? So that interest rate might slightly be higher if your loan balance falls in that high balance margin above the conforming rates. So again, talk to your loan officer, talk to your mortgage banker, see what other options you might have available. And if you actually are in a high balance loan, who knows, you might be in a high balance loan by the difference of $10,000. What does that mean? Well, if you put a little bit more down payment and you bring that high balance under that high balance margin, let's say it's 700,000, then you'd be able to pay the lower interest rate. So yeah, a little bit more money out of pocket, but at least you'll be able to secure a lower interest rate because now you're in your conforming loan amounts. Okay. A couple other things I wanted to talk about is obviously inventory. Inventory is still at all-time lows. There aren't enough homes in the market for the demand that we're seeing in the market by buyers right now. That, coupled with the fact that new construction is also being delayed, we're seeing supply issues, supply chain issues that are affecting construction. Right now, I've got clients that are tied into homes that are brand new that are going to be delivered, let's say July. They just got a notification that they got pushed back an additional 60 days. Why is that happening? Because it's taking them longer to get materials in for the construction, and it's actually costing more money, right? The supply chain is actually constricted too. So supply is low, prices are higher. And what's that doing to the end product? It's actually making that home price a little bit higher as well. So with the advent that there isn't enough new construction going on and inventory is still low, I don't think that there's going to be a crash like we experienced in 2006, 2007, and 2008. I think that's the fear of most buyers, that properties are going to drop that way. And I firmly believe that that's not the case. Again, I'm not a licensed mortgage professional. I've just seen different cycles throughout my career. And in this particular case, it's very, very different as to what happened in 2006 through 8, because most buyers that get loans today, they're fully vetted. What does that mean? That the underwriters are asking for W-2s, pay stubs, copies of tax returns in some cases, W-2s. They need to make sure they have employment. And if you are self-employed, yes, there's products for you out there as well, but they're verifying bank statements for 12 months. They want to see deposits for at least 6 months. They want to make sure that you have enough reserves in your account for at least 6 months of your monthly mortgage obligation. So yeah, every buyer that is getting financed right now and closing on a purchase, they're absolutely vetted 100%. So back in 2006 and 8, we had a lot of loans that were done for people that essentially, if they had a pulse or could fog up a mirror, could get a loan. That isn't the case anymore. Today, because of the experience with 2006 through 2008, many lenders are required to fully qualify every buyer that's buying a home. Now, are we going to experience some foreclosures, and are we going to experience maybe some challenges in the housing industry? Absolutely. I think that will be the case. It's not going to be to the level that we saw in 2006 through 8, but certainly there are people that, went into forbearance without understanding fully that when they got out of forbearance, they were going to have to come current 100% with all the payments they missed. So unless you're sitting on a lot of reserves in your bank account and your savings that you can do that when your forbearance is up, then you'll be able to kind of become current on your mortgage and get reestablished. Then you can continue with that mortgage. But there could be a lot of people that are in forbearance now that when their forbearances are over, they don't have the capital to come current 100%, and they might have some challenges, right? They might have to sell, right? And it's a good time to sell. The prices are still up. They'll still be able to walk away with some equity, but there's others that may not be able to sell. And yeah, we're going to see some foreclosures. Industries, professionals are saying that it's going to be a very small percentage. It's really hard to gauge, but we have started seeing some activity in the foreclosure arena. Just this past quarter, there was about 5,700 foreclosures that happened across the nation. So we are going to see, but that's a very small percentage compared to the vast demand of housing that we actually need for the amount of demand. So, there's a lot of options for you as buyers. Once again, I recommend that you consult with your mortgage banker in terms of what other loan options are available to you. Again, the adjustable rate mortgage products are good products if you understand them. And most people don't know, but the average life of a mortgage loan, even a 30-year fixed, is anywhere between 6 to 10 years. Why? Because people refinance. They take out cash, they refinance their debt, they refinance their mortgage, they pay off all their credit cards, they pay off any debt obligations they have, and then they're left with one mortgage payment, right? Or they pull out equity because they want to do improvements to their home. So the industry average for a life of a loan is between 6 to 10 years. So if you get a 7-year loan product, and here comes in 2 years the presidential election comes in, and you're seeing the rates coming down, it'd be a great time for you to refinance and get something fixed, maybe long term. And then keep in mind too, you still have the benefit of the mortgage tax deduction, right? Whatever mortgage interest or interest rate you're paying on your mortgage, at the end of the year, you're going to get a statement from your mortgage company that you're going to file along with your 10-4 or with your taxes, with your tax consultant, and you're going to take a mortgage tax credit based on what you've paid. So yeah, it may cost you a little bit of money more upfront, but remember, you're going to get a tax credit at the end of the year, could potentially be more savings. And if you're a renter, look, the honest truth is we're not seeing rents coming down. On the contrary, we're continuing to see rents going up. I've been trying to get rentals for a couple of my clients, and the most minimum that I've seen on a 3-bedroom, 2-bath is $2,500, $2,600 a month. And depending on the area, I've seen as high as $3,500 a month, $4,000 a month. So would you rather be paying your landlord's mortgage, or would you rather be paying your own mortgage, building some equity, and building a dynasty for you and your family over time? I think buying now is still a good time to do so. It's still a good decision financially, not only in the short term, but more importantly in the long term. And it can happen. We'd love to help you. If you're thinking about buying, please let us guide you through the process. If you're a homeowner or you're an owner that has a tenant in a property and you want to sell the property because it's time for you to move on and make other choices in your life, we're also listing specialists. We work with sellers all day long. We'd love to sit with you and guide you through the process of selling and help you with your real estate goals. I wanted to thank you once again for joining me this afternoon. I'm Hector Aguilar of Aguilar Realty Group, brokered by eXp Realty. And today we talked about the skyrocketing interest rates and how you can take advantage of other loan products to still buy in this market. Thank you again for joining us. We look forward to seeing you next Wednesday as we bring you another valuable information about the real estate market. Take care, everyone. Once again, if you guys are in the market to buy or sell, our contact information is below. We look forward to seeing you soon. Take care, everyone.